Good afternoon, Jeremy.
Good afternoon, Brian.
Jeremy, in our last interview, we talked about the events that lead up to the completion of the investment mandate. And then it's up to you to realize what's included in the mandate.
Yeah.
Can you take us through the process to make that reality?
Yes, well, first of all, as I say, once we've agreed the mandate between both of us, we have a track to run, if you like, we have a clear objective to deliver on. And we would then need to fashion an asset allocation. Now, 100% of the capital return over time that anybody will get in the stock market, in tradable securities, will be based on the way that capital is allocated. By that I mean, how much do we have in bonds, how much do we have in cash, how much do we have in fixed interest, how much do we have in real estate, how much do we have in commodities, whatever. That will determine really the success of that capital investment over time. Perhaps we could also then look at the three tools that we have, that any manager has to manage money. And they are basically diversification. We need to be well diversified to lower the risk for a given amount of reward return. We can engage in market timing. An example of that would be if we feel that the market is about to collapse, we would go into cash, and then we would buy back into the market when we felt that the market had reached its bottom. In reality, nobody is successful doing that over time. They may have some successes, but over time, nobody can time the market, and no one knows anybody that can. That's one of the reasons active investors fail to beat the market, because they're constantly trading, buying and selling. And they're basically, when they're buying and selling securities, they're making the third decision that they can do. So we've got diversification, market timing, when do I buy and when do I sell? It's a market timing decision. If I hold the market as we do forever and accept the market rate of return, the market cost, and the market amount of risk, effectively we're not making any market timing decision. We simply are always in the market. The third element that we can use is security selection. Why we think we should be buying General Motors and not Volkswagen. When we should be buying it and when we should be selling it. So that's a security selection decision coupled with a market timing decision. Now, again, if we go back to looking academically at the main reasons why we'll be successful with our capital allocation over time, it's primarily all about diversification and costs. It is very little about timing the market, which simply we won't do effectively consistently, and it's very little to do with, funnily enough, it's very little to do with the selection of securities, for some of the reasons that we've spoken about in previous interviews.
Okay. So if you eliminate those last two as part of your investment strategy, what is then your investment strategy?
Well, we would principally go, once we decided on the allocation of the capital for that given mandate, we would then enter the market by buying very low-cost index funds. And, for example, if the market is very high, we would probably use pound cost averaging. So we would go into the market little by little over a period of time.
Okay.
Because, as I said, we do not think we could time the market. But over time, if the market is lower, we will buy more shares. If it goes up, we'll buy less shares. So over time, it will work in our favor. The other element we pay a lot of attention to, because we're not paid to speculate, is the incidence of how foreign exchange, how currencies can affect the return on capital over time as well.
And do you take into account where the investor is located when you look at the currencies he will be invested in?
Yes, that's a very, very important consideration. And that's part of the investment mandate, because if the investor thinks, or if the investor is thinking in euros, for example, but we feel that we need to have an allocation of capital into dollar-denominated areas in the world, which might be growth markets, it may be physical gold, it may be the United States, it may be real estate investment trusts. which is denominated in dollars, then we wouldn't want to take that foreign exchange risk, speculative risk, with the euro against the dollar.
Mm-hmm.
So we've been wanting to have the reward of the underlying investment without the speculative risk of the dollar euro. So in that case, we would hedge the currency in order that we would not be taking a foreign exchange risk. Of course, many would say, no, we'll take the risk because we may win. Yes, we may win, but we may also lose.
Yes.
We would think that risk would be not worth taking.
Okay. In addition to what you have already told us, are there any other aspects that you would take along in your investment strategy?
No, but one of the most important things is that we get that allocation of capital right. So the allocation of capital, the strategic allocation, probably won't change very much. What we do is we would then bespoke that to the individual investor to make sure that the risk versus their expectations are right for them. And in a way, we almost ignore the market, although that's an overstatement. But it is more important that we have the risk ratio to what the investor is wanting to receive. It's very important we have that right. If we have that right, then over time, the market will take care of itself, because effectively we're going to receive whatever the market is giving us, less costs.
Okay. Well, thank you very much for that overview. It still raises the question in my mind, as you say, you're invested for the long term, but whether there might be any circumstances which might make the investment allocation different over time, but I would like to keep that for a next interview. Thank you, Jeremy.
Pleasure.